Hi everyone. Thank you so much for joining us today, and apologies for the slight delay in starting. I'd lost my link to go to webinar, so I had to start all over again, and we managed to lose the dog in the garden. So other than that, it's a normal day. So thank you so much, as I said, for taking the time out of your day to join David and myself to have a look at what's going on in the futures market. But as always, before we start, may I just draw your attention to the disclaimer that I know you can see on your screen. As you know, trading can be a very risky business. And as I said in our earlier webinar, it doesn't matter whether you are a humble trader with a few $100s in your account, or you are a so-called institutional trader with a few $1 billion in your account. It carries exactly the same risk, except your losses are going to be that much bigger. So please, in all seriousness, please don't ever think of using money that you cannot afford to lose. As always, we will be looking at the charts, the markets, through the prism of volume price analysis, seeing how volume and price interact, to see what they can tell us about the validity, the authenticity of the move that is in play, and also as a means of anticipating what is going to happen next, because that's all we want to know as traders and investors, what is going to happen next. The base methodology, the concepts are in the book up on Amazon. And with that book, there's also a book of examples, 200 worked examples, because really the best way to get a grasp of the methodology is just to look at charts, just simply both live charts, but as you can see it developing. But the great thing about the kind of setups and signals that we get with VPA in terms of candles, candle patterns, and the volume, they just repeats. You know, this is a price action is cyclical. You get these cycles, and within those cycles, you will see these, as I said, these setups, these signals, for want of a better word, repeat. And once you recognize them, once you sort of see them on the charts, as the chart is developing, then in live edge of the market, you'll say, your brain will will pull up that example, and we'll see what will happen. Nothing's guaranteed in this world, certainly not in trading, but the probability is that it will recur, and that's the purpose of the 200 worked examples. And this one that accompanies the VPA book is drawn from stocks, but also from futures and commodities. The methodology you can apply, as I said, it's got a ticker on the top left-hand corner, and it's got a volume a profile at the bottom, a histogram. You will be able to interpret the chart through a VPA. And this is really what it all boils down to. You've got volume, price, candles, candle patterns, and probably the most important elements then after volume and price is the support and resistance, those areas on the chart that are created where price is either going to pause or it is actually going to reverse. And on top of that, you can add your indicators, standard indicators, the ones that are on your platform. We've developed our own to support this methodology. And I can see that we've actually got some of our quantum users with us, and also some of our Forex students, because the approach to the markets is pretty universal, in the sense that, let's take all this down, we obviously have our charts. In fact, let me start with what's going on over here. That's the first thing. Right, we have our chart, but we have to look beyond the chart and beyond the market that we are looking to trade. And the first thing we have to try and establish is what is what is going on in the market, the broader market. Those students who are with us who have taken the Forex program know that to become a rounded, more complete Forex trader, you obviously have to understand what the charts are doing and do your technical analysis. But you also have to be aware of what is going on in terms of fundamental releases to do with the individual currencies. And David and I added this years ago, and now you won't read a piece of market analysis without reference being made to related markets. other, so when they talk about the stock market, you will find bonds being mentioned. When they talk about commodities, you will find, the value of the US dollar being spoken about. I can assure you, when we first started, markets were in silos. You either did stocks, you did commodities, you didn't really look across and see what was happening in the other markets, which is ridiculous, because the way the world is today, with the connections there are and the way money flows so quickly out of different assets, they all have some relationship, and at some point in their cycle, that relationship may be very close, and at other times it may be sort of diverged slightly. But unless you understand this, you are actually, when you're looking at a single chart in a single time frame, kind of in your, you're in a little room locked in by yourself. And I'm not saying there aren't traders out there who just look at one chart, one time frame, and can make a decent analysis, but you still have to know what is going on in the broader market. And talking about the broader market, I've got so many notes with me today, because essentially what it all boils down to at the moment is really what is going on in the bond market. Now, to get access to all the data and information you need, unless you pay for it, or your broker platform gives you, access to what is going on in these related markets, obviously you've got to know which related markets to go and have a look at. There are thousands of markets and thousands of instruments. We always suggest investing.com. It's one of the resources we encourage our students to investigate, because I think they practically cover everything that's out there. And this is what you want to have a look at. At the moment, it's the bond market. We've talked about it before. We started to talk about this in these sessions weeks ago, wasn't it, David? We said there was something, a major shift going on in the bond market, and the shift is what we call the yield, which is this here, this number here. And once the yield starts rising, it tells you all sorts of things. It could indicate inflation. It could indicate there's fear in the market. There's all sorts of things. Bonds act as a proxy for all sorts of things. So you have to know what's going on. And until recently, bond market was very, very quiet. Nothing was going on. The yields were very low because interest rates weren't going up. But plenty of liquidity sloshing about. Investors couldn't get hold of enough of the treasuries, and no one paid any attention to it, which is fine. Which is another aspect of related markets, is different related markets come in at different times of the economic and business cycle, so they become more significant to the price action. Obviously, given what's happened with the fallout from the virus, from COVID, until COVID struck, employment wasn't something that everyone knew that employment sort of going along, and the Fed was happily, the NFP came out every month on a Friday, and it looked like jobs were being created. Well, when we all hit a brick wall this time last year, employment absolutely rocketed to levels not seen since the Depression. Employment now is a very, very significant release, and the market will pay very, very, very close attention to it. So my summary is, at the moment, where we are in terms of what the markets are up to, there are two things you have to pay attention to. One of them is the Federal Reserve. You don't fight the Fed. And the second is what are bond yields? What is the bond market saying? And to give it a further refinement, and this is something, as I said, traders would not have considered in any way, shape or form, is obviously bonds are sold, they are sold at auction. When I talk about bonds, I'm talking about treasuries here, US treasuries. And basically the Fed, they need money, so they sell a bond, and they have it as an auction. If the auction goes well, and it's called the bid to cover ratio, if it goes well, it's covered, and they get rid of the bonds, and everyone's happy, and the yield isn't, isn't so, it's what they expect. The market is happy. It's not rocking the market, as it were. a couple of weeks ago, there was a 7-year auction, which is quite an unusual one because you tend to have the 3, the 2, the 10, and the 30. But there's a 7. You can make the duration of the bond anything you like. You can make it a month, 3 months. It doesn't matter. But it was a bit of a disaster a few weeks. It really, there wasn't the take up that they expected, and that sent a lot of, there's a lot of worries in the market, and it caused the market to have a quite severe pullback. So this is another piece of information that you need just to keep an eye on. Then there was the subsequent 20-year one, and that went off a little bit better, and the market was kind of relieved by, oh, that's great, that's really so. There's two things we have to say. What is the Fed going to do about rising yields? Because when things are at a normal, as it were, without this the impact from the virus, when yields start to rise, what central banks do is they raise interest rates. What Powell has said, he said he's not going to do that because in raising interest rates, it's going to make the cost of money more expensive, and it's going to directly impact those, employment. Why? Because companies are going to find it more expensive to borrow money, etc., etc., etc. We're all going to find things more expensive if interest rates start to rise. So he has actually said, I'm willing to allow inflation to go higher. Certainly, they have this nominal 2%, possibly even higher, because my priority is employment. The problem with that is there's kind of a bit of a paradox, because if you, first of all, that's assuming you can keep hold of inflation. Inflation is a bit like a tiger, the tail of a tiger. You think you're going to control it, but it can sort of outwit you very, very quickly. And those of us old enough to remember the days of when our mortgages were going up in, is it 5 and 6% a day, David? I think ours hit 17% at one point. And secondly, is the market going to allow that? So what I'm trying to say is those are the two aspects that you have to look at what is going on at the moment. One of them is the yield, and what is the Fed, what are they going to do about it? And you'll come across expressions like yield curve control. So even if you are a day trader and you're only going to be in a trade for a very, very short space of time, it will impact you because it will give you what the bias of that session is likely to be. Is it going to be up? Is it going to be down? Or as we have at the moment, certainly with the NASDAQ, it's actually not going anywhere. So what I've got here is this is futures. I've actually got the futures here on MT4, because you can trade a version of the futures, which is contracts for difference, which I believe is what Mr. Huang was doing, the guy who was just who has taken a bit of a hit because he didn't sort of manage his risk properly. He had his margin call, and you can read about it in the in the press. He was actually, I believe, he was trading trading the stocks themselves. I'm not really sure what he was doing, but essentially he was allowed to borrow heaps and heaps and heaps of money to trade on a very high leverage. As retail traders, the regulators are so hot on brokers who have retail clients not being allowed to leverage up. In other words, not just to keep the risk under control. In Forex, as we know, it's now down to, is it 1 to 50, David? Even 1 to 10, whereas it used to be 1 to 500 and 1 to 600, as it were. Those days have, because Forex is so risky. And yet on the institutional side, you have this guy who apparently was has already had some blow up in another fund. He'd set up this family office, and they were sort of throwing money at him and allowing him to trade at 50 to 1, as it were. Doesn't matter whether you've got, as I said, you've got $500 in your account or you've got 5 billion in your account. The risk management should be identical. In fact, the more money you've got, the more conservatively you should actually trade. Right, let's have a look, see what's happening on the indices. The reason that I put the NASDAQ up, a couple of things. very, very quickly, let's just look at the other indices, because there's a bit of divergence going on at the moment. And this is also what you'll find, and in as much that with sentiment, until fairly recently, everyone kind of looked at the S&P 500, and that was your kind of benchmark, and it was the shorthand. Well, what's the S&P 500 doing? What's the VIX doing? And whatever the S&P was doing, the Nasdaq was pretty much going to follow, and the Dow as well. So all three indices would sort of be marching along together. That's gone. That's finished, and it's part of the reason is because what is happening in the bond market with the shift in long-term shift in sentiment, so maybe we're going to have a major correction coming up. And there's also what's called a rotation out of growth stocks, riskier stocks that are represented by the Nasdaq into what we used to call defensive stocks, value stocks, stocks that do well when there is a downturn. The Dow tends to reflect most of those stocks. The Nasdaq is your high growth stocks. The S&P is just a much broader index because it's got 500. I haven't got the Russell at the moment, the futures for the Russell, but the Russell is the small caps. So if you want to see in terms of sentiment, it seems to me from this is purely on observation, that when the markets are positive and they're looking, they're risk on, as it were, yes, the S&P, but it's the Nasdaq. The Nasdaq seems to be some kind of a bit more of a bellwether for it. But we then have to look, well, what is the Nasdaq itself doing? This is my 5-chart profile for the NQ, which I said it's the CFD version for the NQ. And we always start with the daily. What is this daily chart telling you? And it is really reflecting this kind of flip-flopping that we've been seeing. The market can't decide, does it actually want to go carry on up? Then you have another down day, then you have a bit of an up day, then you have another up day, and then 2 down days. You have this, it's not quite whipsawing, but it's very, very choppy. It's also at what we call the volume point of control, which is the fulcrum of the market for this particular instrument. This is based on our VPOC indicator. And this is where the market is congesting. It's volume and price over time, and you can see the bulge here. It's a bit like a distribution curve. So you see, and what this market is, when it's at this point, this is the daily chart, but anything that you trade, the market needs to decide, is it going to go up? Is it going to break to the upside, or is it going to break to the downside? Now, if you are trading a stock, an index, a commodity, a Forex pair, it doesn't matter what you're trading, and you have a daily chart that looks like this, at best, you will say that you're probably going to get some good two-way price action in the faster time frame. You're not trading, if you look back here, when this was in a trend, this is a clearly discernible trend. You've got higher lows, you've got higher highs. So on the faster time frames, what you will be looking at is either looking to join that trend higher, because clearly it is in a trend on the slower time frame. So any pullback and correction will probably be an opportunity to enter the dominant trend. And so any potential signal or setup that you see to the downside may be tradable, absolutely tradable, but you're probably not going to stay in there very long, because the bias in the slower time frame is to the upside. When you get a pattern like this on the daily chart, in a way, you don't know, because the driver for this index at the moment, as I said, are these other factors that are in the broader market. which we put under the label of sentiment, and that is going to be reflected in, you know, what are the bond yields doing, what is happening with the rotation. So it is much more of a multi-dimensional approach. In the Forex program, we call it the three-dimensional approach, which is the technical, fundamental, and the related. But if you want to use another expression, you could say it's more of a multi-dimensional approach. So what's happening today? Is the market in a good mood? Well, we certainly have it looks like it's moving away from the volume point of control. So we look at our faster time frames, which is, you know, what we're looking at for potential entries. And this is where two things. First of all, having a chart which is non-time based, and I have the Renko, David has both Renko and tick charts, because what Renko does, it gives us this lovely geometric look at just the price action. And with the indicators that we've developed, the trend dots, the trend monitor, and the levels, you get very, very clear potential entry signals. You then, once you've entered, what the Renko will do, the beauty of the Renko, it then helps to keep you in the move. We've had, as you can see here, we had a couple of pullbacks, we had a little bit of congestion, but the trend monitor has stayed blue. Even the dots have stayed blue. I don't think we've got any red dots. We've got a little grey one. The grey one comes out when it is congestion, and now it's moving higher. And now we look to our levels. It's on the R4, but it still seems to be pushing higher. And it is going with what we can see on the daily chart. Yes, it is in this congestion, but today's candle looks like it wants to push higher. So it's, you know, it's a good mood day, as it were. On the hourly chart, because the Camarilla levels, there are two values to these levels. The daily ones are you get new ones every day. Sorry. On the time frames up to but not including the hour, you get these values recalculated at the start of the new session. So on the faster time frame, but on the hourly and daily ones, these are the levels for the week. So the rest of this week, these are the key levels for the NQ on MT4. And we can see here the third and the fourth level are the most important, but it's actually, we've had a lift off from the 3 and it's going up higher. And where's it going to? Well, it's pausing here. All the levels come into play at some point, but some will more likely lead to a potential reversal. And that reversal often happens at the 3rd and the 4th. So if this is going to go higher, where's it going to go to? Well, it's hit the 1, we'll certainly get to the 2, and if it's a really good day, maybe we will get to the 3 as well. But looking on the faster time frames, and I'm right down on the 5-minute chart, we've actually had this little break from the volume. The volume point of control is obviously at different points on the different time frames, but we've actually had this is the move higher. If we look at the trend monitor, this is the inrush of the start of the session. Is it the start of the session? Yes, 2:30 the open. So you have a ton of volume always comes in. Anyway, we've got the volatility triggered as well. And where are my values for this one? I've actually put them on the 15-minute, but it's the same. Let's have a look. In fact, it actually does hit its R3 on this time frame. It's at the R4, which often does cause a pause. We've got a volatility. We can expect the price action to retrace into the spread of that candle. Where's it going to go if it gets through the R4 with a ton of volume underneath it? Well, we've got the R5 and then the R6, and you use the two levels on the different time frames when you get a confluence. What helps to keep you in is the Renko chart, as we can see here, because that just takes away the noise that you get on the time charts and on the candles. And if that is saying, if that is blue, that is helping to keep you in. What you now need to keep an eye on is on the time charts and look for the signals and candles on the time charts to see if in fact the move is coming to end. Because for exits, looking at the time chart first is probably not a bad idea, and looking at the candle and saying, yeah, do you know, it's been a good move, now it's time to get out. Right, I'm just going to pass over to David. I'm going to keep an eye on this. It certainly looks like it is it's going to be a good day, certainly for the NASDAQ, and I'll see what David has got over the other side. Is that all right, love?
Thanks, darling. Hopefully you can hear me. Hopefully you can see my screens. I just went over onto the currency arrays because it's just a classic example of what sentiment is at the moment. It's pretty clear what it is. Everyone is, or the market per se, is selling the yen, and you can see it here on 5, 10, and 15. So it's just a great visual way, isolating out on the yen or the dollar or the Swiss franc, whatever it is, to get a fix on sentiment. It's just a very simple, quick, easy way just to give you a view. And you'll also see, you know, if that sentiment is strong, then these are going to swing up here. If it's going to start weakening, you'll see them dropping away here. You'll start to, the sweep will be down here. These will start to sweep down. These will start to join them in due course. But it's just a very quick visual way of seeing it all in, you know, in terms of a snapshot sentiment, if you will. Just head over very quickly to the charts themselves. This is the 3, YM, NQ, ES, 5 minute on the top line, daily on the bottom. That's what we've got going right now. The YM has shot up to the big volatility candle at the open, tons of volume, big spike, straight onto the volume point of control. The one that's moving is the NQ at the moment, but it's quite toppy here. You've got some weakness coming on that particular candle, lots of volume here. It's what you expect to see, but the general sentiment is still pretty bullish. It wants to go higher. You know, that's what it's trying to do. This is where we are in terms of the daily. This is the congestion we're in on the NQ. Right around the volume point of control, very tight. But the other two, as I mentioned this morning, are trying to break out into high new ground. That's the YM, that's on the daily, and the same on the ES, similar sort of picture. So they are still trying to get that bullish momentum, break through there, just move that out of the way, and on up past, where are 39.80 and on into pretty much virgin territory at the top there. So it's not going to take a huge amount of effort to bust through that. So, you know, what have we got going on right now? In congestion on the YM, no great surprise at the volume point of control, plus we've got the volatility trigger, no great surprise, ton of volume under there, it's what we expect. The NQ is trying to move higher, it may well try and drag the others up, and the ES is also oscillating around the volume point of control for the time being. So from an intraday perspective, it's still bullish. Just checking over on the other charts, seeing what's going on in TradingView. The VIX is falling, so that's good. It's down, you know, it's gone from 20, it's aiming down towards 19, so that's going in the right direction in terms of sentiment. What's interesting is the UK FTSE 100 is down, certainly from lunchtime our time. The last couple of hours, it's trying to bottom out now, but it's certainly off. So it's quite an interesting divergence in terms of what's going on in the UK markets as opposed to what's going on in terms of risk markets in the US. Very quickly, let's just round up and see what's going on in terms of the other markets. Oil. Let's pop that up. Actually, I know where we're going to go. No, I know where we're going to go. Just pop this up on the daily. Written a lot about oil over the last few weeks and months. You're all aware of what's been going on in terms of the Suez Canal. It had an impact, but it was really news that was used to oscillate and move the oil market around. It's not really going anywhere. It's still bearish. You can see the trend monitors down here is red on the daily chart. This was the level of resistance we highlighted at $67 a barrel, which it hit, never got through there, back down to the volume point of control. So more congestion to come in terms of oil. Very quickly on to gold. Still struggling, poor old gold, been very bearish. Again, something we've written about extensively on Anna's site. You'll see it all there. We keep getting these rallies and reversals, rally, reversal, rally, reversal. Look at the volume there. Look at the volume falling away on that one. You know, classical, trying to rally, falling volume, over it goes again. And it keeps on happening all the time. We had this one, it kind of hinted that it might be a possible reversal, but then all this weakness comes in with these wicks here, lots of volume, and we rolled over again and on down. At some point, gold will bottom out. It will largely be driven, I suspect, by inflation in terms of longer term bullish momentum. But for the time being, we're not seeing any strong buying there. What did we have yesterday? Nice widespread countdown candle, good volume under it. You know, there's no significant buying in there. So there's no reason other than if there was some fundamental driver that might come into play. There's no reason to suspect gold's going to reverse in the short term, but longer term, if inflation comes into play, it will. In terms of intraday trading, it's exactly the same as any other chart. There we go, big volatility drop, nice trigger, everyone jumping in there, going short, getting caught out, lots of volume under there, lots of buying, decent opportunity to trade that to the upside, even though the longer term bullish bearish momentum is in play. The volume is rising, so that looks okay. Moving up here, low volume node at the top of the chart here, up at 1694 onto 1695. See what the volume shapes up on this. This is on 1 minute. Just see what the 15-second chart looks like. One of my favorites. There we go. That's it. Trap, reversal, on up. It's classic stuff. And that's the power of the volatility indicator. And the beauty of the volatility indicator, it actually appears in real time. In other words, you don't have to wait for the candle to close out before this trigger appears. Now, on a 1 minute chart, not important. On a 5 minute or a 10 minute or a 15-minute chart or slow, it is important. Bit of weakness coming there, volume under there, you can see it here. Not a great deal of selling under there, more buying under that particular candle. Wick to the lower body, good volume. Push up again, on up it goes. And that's on a very fast chart, but that could be any chart, could be a stock, could be an index future, could be commodity, it doesn't matter. The principles are the same, as indeed are the principles of using multiple time frames. You get to see the volatility trigger here on 3, which you don't see on 1, and you don't see it over on 15-second here. But that's what you're looking for the whole time. Constantly scanning across the chart, see what's going on, and giving you all those little pieces of the jigsaw puzzle to help. The trend monitor, you can see, is bright blue, keeping you in. We had a little bit of a transition here, but came out the other side into blue right the way throughout here, and blue down here as well. So in terms of intraday trading, it's pretty bullish. Nice volatility trigger here now. We've got a volatility trigger on 1 minute. So expect a bit of congestion, maybe a minor reversal there. That's what you're waiting for. If you had money in the bank at that point, close it out, get out, take profit off the table. Wait, be patient, wait for the next phase of price action to break. What are you waiting for? In this case, very simply, you'll be waiting for it to go beyond 97 up to 98. Once it gets through 98, if it's going to carry on to the upside, you jump back in again. If not, you're then looking for a possible reversal trade back down to the VPOC. And that's, it's as simple as that. Look at the volume falling away. You've got 2 down candles there. Volume is falling, so it doesn't look particularly bearish at that point on time. We're going to have to run because we've got another webinar coming up very, very soon. In fact, in 7 minutes time. So we're just going to grab a drink and then we will be back with you. So thanks very much indeed for coming along to this one. Sorry we were late in starting. Apologies for that. We'll try and start on time in the future. And we will see you shortly. Enjoy the rest of the trading day if you're not coming back later, but we will see you in a few minutes time. So thanks for that and see you soon. Bye for now. Where will you find all the bits and pieces? You'll find them here this is where you'll find all the indicators at quantumtrading.com. We have all the platforms, MT45, NinjaTrader 7.8, TradingView, which I've just been through with you, and also TradeStation has now been launched. We've got 2 versions of that. That's the TradeStation 9.5 with interactive brokers as the live feed, and TradeStation 10, which is TradeStation Securities, and they of course incorporate the awesome power of radar screen, which is wonderful. And remember, when you invest with us, there's several things to remember. First of all, you can move your indicators from platform to platform. So if you start with one platform, you perhaps want to move to another platform, that's perfectly fine. We don't charge you for that. We just transfer your indicators across. We have a lot of customers who start perhaps with MT4 or TradingView, then they want to move to TradeStation or NinjaTrader. Perfectly fine, we do that for you, absolutely no charge at all. And finally, if you do, whether you buy one indicator or several, if you upgrade to another package, for example, we will always give you a credit for those indicators. So you never lose out, you never lose your initial investment. We always protect you in that respect. So you'll always receive a full credit. And finally, of course, if you invest in the full package, even more so with TradeStation at the moment, because it's currently at $677, I think, off the top of my head. But once those other indicators are developed for the platform, then we will be increasing the price, which will align with the MT45 platform. So it's a great time to invest with TradingView because, as I say, you'll get all those indicators free of charge. You won't be paying for them. So it's not a bad time to invest in that package. But all the other packages, if you invest with the full package, we also give you all future indicators we develop free of charge. It's just our way of saying thank you. Finally, just to give you a heads up on the education program, I've just touched on one or two aspects of it. Obviously, within the program here, it's called the Complete Forex Trading Program because that's exactly what it is. To say it's comprehensive is a disservice. It is everything you need to know. You have all the modules which cover the psychology, the fundamental analysis, relational analysis, so you'll understand how markets relate to one another in terms of risk, in terms of relationships to bonds, bond yields, how commodities fit into that structure, and of course the actual relationships within markets, you know, how currency pairs relate within the markets themselves. You've got a deep dive into technical analysis, of course, that is VPA. It's all the Wyckoffean principles, it's Wyckoff's three laws. And in addition to that, it's how to apply VPA, not just to straightforward analysis, but we teach you how to understand when a trend is coming to a pause point and to identify whether it's actually a reversal in trend, in other words, from primary to primary, or is it simply a pullback? And if there's one thing that you would learn, it is simply that, because that will stop you getting out of trades too early. It's as simple as that. The mechanics of trading, and then there's something like 200 to 300 hours of video, VPA chart examples, how to use the indicators, pulling it all together, topic webinars with Anna and myself, a huge webinar library, and a resources section as well. And of course, all of that is backed up now. We've added the QTE funded Forex program. And the reason we've done it is very simple, because we wanted to give you, our students, and this is only available to students on the program. I'm sorry, it's not available to anyone else. If you're a student on the program, you have the option to join. It's there to give you the opportunity to leverage your knowledge. And it's very simple in the way it works. It's a no risk deal as far as you're concerned, because you are trading our money. It's as simple as that. We give you the opportunity to start with an evaluation account at $5,000, $10,000, or $15,000. Once you've achieved a very achievable target at that level, you've proved to yourself that you have the consistency to trade, you've proved to us you have the consistency to trade, we then multiply it by 4. So if you start with a $15,000 account, we push you up to 60,000, and thereafter we double it. So you go from 60 to 120 to 240, and in pretty much no time at all, you would be up trading $1 and $2 million accounts. It is simple as that. There is no risk to you. There's a one-off fee to pay. That's it. That's your only expense of getting into that particular program, but it's entirely optional. What we've now bolted together, we feel it gives the complete package, if you like, of giving you the opportunity as a student to benefit from your knowledge and prove to yourself that you can trade a large money account at no risk. So that's it. Hope you've enjoyed this particular video. Lots more to come as always. Thanks for watching. See you again soon, and bye for now. Where will you find all the bits and pieces? You'll find them here this is where you'll find all the indicators at quantumtrading.com. We have all the platforms, MT45, NinjaTrader 7.8, TradingView, which I've just been through with you, and also TradeStation has now been launched. We've got 2 versions of that. That's the TradeStation 9.5 with interactive brokers as the live feed, and TradeStation 10, which is TradeStation Securities, and they of course incorporate the awesome power of radar screen, which is wonderful. And remember, when you invest with us, there's several things to remember. First of all, you can move your indicators from platform to platform. So if you start with one platform, you perhaps want to move to another platform, that's perfectly fine. We don't charge you for that. We just transfer your indicators across. We have a lot of customers who start perhaps with MT4 or TradingView, then they want to move to TradeStation or NinjaTrader. Perfectly fine, we do that for you, absolutely no charge at all. And finally, if you do, whether you buy one indicator or several, if you upgrade to another package, for example, we will always give you a credit for those indicators. So you never lose out, you never lose your initial investment. We always protect you in that respect. So you'll always receive a full credit. And finally, of course, if you invest in the full package, even more so with TradeStation at the moment, because it's currently at $677, I think, off the top of my head. But once those other indicators are developed for the platform, then we will be increasing the price, which will align with the MT45 platform. So it's a great time to invest with TradingView because, as I say, you'll get all those indicators free of charge. You won't be paying for them. So it's not a bad time to invest in that package. But all the other packages, if you invest with the full package, we also give you all future indicators we develop free of charge. It's just our way of saying thank you. Finally, just to give you a heads up on the education program, I've just touched on one or two aspects of it. Obviously, within the program here, it's called the Complete Forex Trading Program because that's exactly what it is. To say it's comprehensive is a disservice. It is everything you need to know. You have all the modules which cover the psychology, the fundamental analysis, relational analysis, so you'll understand how markets relate to one another in terms of risk, in terms of relationships to bonds, bond yields, how commodities fit into that structure, and of course the actual relationships within markets, you know, how currency pairs relate within the markets themselves. You've got a deep dive into technical analysis, of course, that is VPA. It's all the Wyckoffean principles, it's Wyckoff's three laws. And in addition to that, it's how to apply VPA, not just to straightforward analysis, but we teach you how to understand when a trend is coming to a pause point and to identify whether it's actually a reversal in trend, in other words, from primary to primary, or is it simply a pullback? And if there's one thing that you would learn, it is simply that, because that will stop you getting out of trades too early. It's as simple as that. The mechanics of trading, and then there's something like 200 to 300 hours of video, VPA chart examples, how to use the indicators, pulling it all together, topic webinars with Anna and myself, a huge webinar library, and a resources section as well. And of course, all of that is backed up now. We've added the QTE funded Forex program. And the reason we've done it is very simple, because we wanted to give you, our students, and this is only available to students on the program. I'm sorry, it's not available to anyone else. If you're a student on the program, you have the option to join. It's there to give you the opportunity to leverage your knowledge. And it's very simple in the way it works. It's a no risk deal as far as you're concerned, because you are trading our money. It's as simple as that. We give you the opportunity to start with an evaluation account at $5,000, $10,000, or $15,000. Once you've achieved a very achievable target at that level, you've proved to yourself that you have the consistency to trade, you've proved to us you have the consistency to trade, we then multiply it by 4. So if you start with a $15,000 account, we push you up to 60,000, and thereafter we double it. So you go from 60 to 120 to 240, and in pretty much no time at all, you would be up trading $1 and $2 million accounts. It is simple as that. There is no risk to you. There's a one-off fee to pay. That's it. That's your only expense of getting into that particular program, but it's entirely optional. What we've now bolted together, we feel it gives the complete package, if you like, of giving you the opportunity as a student to benefit from your knowledge and prove to yourself that you can trade a large money account at no risk. So that's it. Hope you've enjoyed this particular video. Lots more to come as always. Thanks for watching. See you again soon, and bye for now.